What's going on, guys? So in this video today, I want to talk about a stock that is a big value stock. In fact, as you can see on the right, this is one of the stocks right here. I'm not going to keep this secret. It's Meta. I want to show you why Meta has so much money that you can make off of it with the options. And specifically, Meta is a very good value stock. So right now, we've actually seen Facebook parent Meta Platforms report first ever revenue drop, which is pretty shocking in some ways because this company has been very, very profitable. It's been growing revenues for a long time, but hey, they have some issues right now, and the revenue is not doing too well. So I've really done a lot of research that I want to divulge to you, and I want to show you how you can make money off of this stock. So first comes first is I really want to point out Meta's price to sales ratio. So there's a few different ratios that I want to look at, but the first one is price to sales. It has now fallen to 3.99, which is a pretty low ratio, especially if you compare it to something like Apple. So Apple is a pretty good value stock. In fact, Warren Buffett has like so many shares of Apple, right? He's been invested for a long time, and Apple is a growth story, but it's not really trading for very high multiples. And the price to sales is actually 6.62. Now, if you look at Tesla, Tesla's probably somewhere around 15. So Apple is half of Tesla, and Facebook is actually 2/3, which is 33% less than Apple in terms of its price to sales ratio. So let's go back to Facebook, but essentially Facebook is trading for a very big discount compared to its peers. Now, I understand that Apple isn't really a direct peer, but Google is. And if I look at Google, Google is also trading for a higher price to sales ratio. And then we're going to talk about price to earnings ratio. And then we'll get into some options. I'm going to show you what I would do with the options on Robinhood. But still, if I go to statistics right here for Google and I look at Google's price to sales ratio, it is less than Apple. It's at 5.47, whereas Apple's was over 6, right? But Google, Apple, Microsoft, Amazon, all of these companies, they are really stable companies. Now, Amazon's going to have a lower price to sales ratio. The reason for that is because Amazon has tighter margins. They're selling products, whereas Google and Facebook are really selling ads. They're the leaders in advertising, right? So ads are very high margin, whereas Amazon selling products isn't as high margin. So if I scroll down over here, you'll see that the profit margin here for Google is 25%. Their operating margin is 29%. Now, if I go to Amazon, I'm just giving you the full picture. I want to really show you how much I've actually analyzed Facebook in relation to its peers. Because that's actually how you do research. You look at a stock and then you look at its peers and you try to understand, is this stock trading fairly compared to its peers, or is this stock on a big discount, right? Or is it, overly expensive, whatever, right? Comparison is the key to see if a stock is actually fairly valued or if it has a discrepancy. So for the price of sales to Amazon, it's 2.6. And again, that's because their profit margins are literally like 1/5 or even 1/6, right? Because Google was 25 and Amazon is 4.48. So that's actually a 5 times difference. So I wouldn't be surprised to see that the price of sales would be 5 times lower, but it's not. It's 2.6. And in theory, if this was an advertising company with higher profit margins, this would probably be a price to sales ratio of 10. So again, going back to the fact that Meta or Facebook is trading very, very cheaply in comparison to the other tech stocks. And Meta is still a very key player, although of course they do have some issues. Now, Meta has actually gone down. Let's go to the chart. Meta has been a stock that was actually over $300 per share. This stock was almost $350 per share, not even like 6 months ago, right? If I go to 1 year ago, this stock was over $350 on November 26, 2021. So now this stock is in a territory where I just think this is a huge value play. And specifically, I want to show you 2 different things that I'm going to do on it. The first one is going to be selling a put option. I'm going to show you what strike I'm going to sell a put option at. And I'm also going to show you a covered call. I'm going to show you which strike you can sell a covered call. And that's because Meta is going to be a very good play over the next 6 and 12 months and even 18 months. I think that this company, although it does have a slowdown in revenue, it is still a very good company for the long term because they're going to continue to increase their profits. They own things like WhatsApp, and with WhatsApp, they're going to look to monetize that. And I think they're going to be fine long term, but they're especially going to see some big issues in the shorter term. And I think they're going to have some type of similar movement to Netflix. And as we saw with Netflix, Netflix had a couple quarters of bad earnings. It came down, but recently it's been pretty stable. And that's exactly what I think is going to happen with Facebook. I think that they're going to have some tough times ahead in terms of their business, but the stock is going to be pretty stable. So let's go ahead and take a look at Meta Meta stock together. As you'll see, I've been making pretty good money on Meta. I just sold a put option right before earnings for the 140 put option. That's the strike price that I picked. And that's because I didn't think that Meta could fall down that low, and it's not going to fall down that low. So I'm going to give you guys a few different plans. If you have a small portfolio or a medium portfolio, even a large portfolio, I'm going to show you a number of different strategies and trades that I'd be doing on Meta using options. So the first one that I'm going to do is I'm going to look at selling a put option. So if I go to the chart, I want to sell a put option around the $154 level. That's because there's a lot of support right there given the Bollinger Band. So the Bollinger Band currently is showing $154, and I'm looking out for 10 days ahead. So my Bollinger Band period is 10 days, and my standard deviation is 2, which just means that 95% of the time, or even 96% of the time, this stock is going to stay above that level. So I'm very confident to sell puts at $154 per share. Now let's see how much money we can make, and also let's see which date we're going to go out until. So if I go to trade Meta options, the first date that I want to go for is going to be a 1-week option. I really like 1-week options because specifically when you sell 1-week options, they're decaying very fast. They're rapidly decreasing in value because beta is very high. The option is decaying, and that decay is actually yours when you're selling an option. So I'm going to go to the expiration date of August 5th. I'm going to go sell put option. So I'm going to sell a put option at $154. However, you will notice that the 154 strike does not exist. So instead, I can either go for the 155 or I can go for the 152.5. I'm fine with both. I think both of them could be good. The 155 is a little bit more aggressive. It has more premium. In fact, it's going for over 1% because 1% is about $155. This is actually 1.5% in about 7 trading days. This is a very good return, and 155 would be fine if you're a little bit more aggressive. But if you're a safer investor, you're looking for consistency, and you're looking for consistent returns without really losing your money or actually getting put to stock, then $152.50 is going to be better. Now, the strike here is actually only offering us a little bit less than 1% in premium. It's $143. But 143 is pretty good because if you do that on a monthly basis, you're still going to make about 4% a month or about 48% a year. So I'm a big fan of the 152 strike price. Now, another thing that I would do is I would go out a little bit farther. So instead of August 5th, you could actually go for the monthly expiration of August 19th. Now, typically options expire the 3rd Friday of every month. So that would be August 19th. So for August 19th, I would also go for the 152 strike price. Here though, you're only going to collect about 2% or about 2.5% premium, but that's pretty good because you're able to collect the premium up front. As soon as you sell this option, the money hits your account, you can withdraw that, or obviously I think most people want to reinvest that money. This is a great way to grow a medium account. Now, the way to grow a small account would be to do a put credit spread. A put credit spread is very similar to selling a put option. Let's say that we want to sell the 152.5 put option. Well, one of the issues is that this is very expensive. It costs a lot of money. So instead, what you can do is you can still sell the put option, but now you can reduce the amount of collateral that you have to put up by buying a put option. So I'm going to buy the put option below, which is the 150 strike. I'm going to go ahead and buy this 150 strike, and now you'll see that my maximum loss is only $182. So that's fantastic for a small portfolio. Anyone with even $500 could enter into this position. In fact, it's only a $182 position. Here, you're collecting a maximum profit of $68. That's coming in the form of premium upfront. So you're making $68, you're risking $180. That is about a 35% return. So here you can make 35% in as little as 3 weeks. So during the next 3 weeks, you're basically making 10% a week. Now, this is a little bit riskier than just selling a put option because when you sell a put option, the worst that happens is you get put to stock. You have the collateral. It's not really a big deal as long as you like the stock. But with a put credit spread, if it goes in between your strike prices, you're going to start losing some money. You're going to have to close this position. I like closing these type of positions as soon as it hits $152.50. That's because as soon as the stock goes below my put strike, my higher put strike, at that point, I'm looking to close the position. I'm probably going to roll it into a similar position, but lower strikes, or I'm just going to close my position and call it quits on this stock for 31 days. In this scenario though, most of the time, this stock is going to end up above $152.50, meaning that the $68 that you collect is going to be yours, and then upon expiration on August 19th, this is no longer an obligation in your portfolio. You're all good, and you can do this again the following Monday. And this $182 in premium will again be freed up, so you can do anything that you want with it. This is a great way to grow a small portfolio, and I think Meta is one of the best stocks that you can do that on right now, because I'm not positive that the bear market's over. I do see that the market is going up, but you never know because there's a lot of volatility in the market. But with Meta, I think this company truly has a lot of value. I think it's sold off to the point where this strategy does make sense, but I wouldn't put all of your eggs in one basket. For example, when I'm selling a put credit spread, I would do maybe 5 or 10% 50% most of my portfolio in any single one trade. Especially if you have a small portfolio, you can go a little bit more aggressive, but if you have a bigger portfolio, then you really don't want to put too much of your eggs in one basket because this position could end up not going your way. To be specific, if I expand this option right here, you will see that the Greeks, which is delta, gamma, beta, vega, and rho, the delta here is 0.29. That means that about 29% of the time that meta stock will go down to about $152.50, meaning that 70% of the time you're good. You're going to end up winning, but 29% of the time you're going to end up having to close this position. Now, as soon as this position touches $152.50, at that point you would close the position and you would not lose $182. That's because as long as there's some time available and there's some time left, then this $150 put option is still going to have some value. So when you end up buying this back and selling the $150 put at the same time, right? Because you're going to be closing this put credit spread, you're not going to end up losing $182. You're probably going to end up losing maybe $30, $40, $50. It really depends where the stock is at and how many days you have until expiration. But the good news is you cannot lose $182 unless you really wait until expiration. It's really difficult to lose this full amount. So in my mind, you can make $68 and at most you can lose about $100 if this position turns into a negative 100. At that point, you can just close this position and leave it be. So this is the strategy that I think will grow your portfolio if you have a small portfolio. Now I want to show you what strike I would pick for a covered call. A covered call is also a very similar strategy to selling a put option. Most people don't actually understand that, but they're actually two very similar things. So they're both pretty bullish strategies. With selling a put, you're basically going to get into the stock. With selling a covered call, you have to have 100 shares and then you sell a covered call. In fact, if you Google a put and then a covered call, so sell put, actually let me show you this. So this is going to be kind of mind blowing, but look, I wrote sell put. So this is what a sell put looks like, okay? So sell put right here, right? Many images here. That's a sell put, that's a sell put, that's a sell put, right? Now, if I go to covered calls, you will in fact see no difference. It's actually a very similar strategy. The risk and return profile is very, very similar. So actually, this is pretty mind blowing whenever I teach my students this in the OIB group, the little boot camp that I have, which of course you can check out in the description by clicking that first link and talking to someone on my team. But whenever I tell them this, they're like, whoa, I never really thought of that. Even if they're a pretty experienced trader, they're like, I didn't really know that. So they always ask me, should I sell a put? Should I do a covered call? And I pretty much always have to say there is, there's a little bit of a difference, but still they're really, really similar. So a covered call and selling a put is very similar. So let me show you a covered call though and what strike I would pick. So for a covered call, I really like this stock, right? I like Meta for the long term, and a covered call does have one advantage over selling a put. With selling a put, you collect the premium, that's it. Now with a covered call, you have the advantage of having the stock, so the stock can appreciate in value. Because the stock can appreciate in value, you want to pick a strike that is slightly out of the money. So for example, let's pick an expiration day of, let's say September 16, which is about 6 weeks out. Very good amount of time. I like to trade between 1 to 4 weeks. 6 weeks is fine and 8 weeks is fine as well. Anything less than 3 months is pretty decent, especially for a covered call. A covered call is amazing to do a little bit longer in terms of date because then, you can have some capital appreciation and that's a very good thing for your portfolio. So basically this stock is about 160 bucks per share. What I would do is I would sell a call option at 165. If you look at the premium right here, $8.15. That is really, really good. So that is actually a premium of about 5% in just 6 weeks. So obviously a lot of traders are now thinking that this stock might go up, but also the premium is high because the implied volatility is high. The implied volatility is 42, which is actually not as high as I thought, but this premium is just really, really amazing. Again, I'm not really sure why it's so amazing because the implied volatility is only 42, but I guess it's because it's a significant risk to lose your shares because the delta is pretty high. It's 46 or really 47 delta. So that doesn't really matter to you though if you have 100 shares. So if you have 100 shares, right, you own the stock and you actually get to collect $8.15 today right now if you sell this covered call, and this stock can go from 160 basically to 165. So you can make another $500. And that's why the break-even price here is 173, which is a very high return. This is like a 7% return in 6 weeks, which is basically over 1% a week in earnings. So this is the strike that I would pick if you have a medium-sized portfolio and you can afford 100 shares. If you can't, then I would go with the put credit spread. But either way, I think Meta is such a good stock right now to trade. I hope you make some money with Meta and eat some lobster dinner. If you ever want to follow my trades and watch me trade live, then you can just hit that first link in the description and I'd be happy to work with you, coach you, and show you all the trades that I make on Mondays, Wednesdays, and Fridays. See you in the next one.